Okay, so let's start with the derivatives chapter, and I'm going to quickly cover the strategies part. So we have a couple of strategies over here that we have seen all across our CFA curriculum. So we know that all synthetic positions can be derived from the put call parity, which is stock plus put is equivalent to buying a bond with the par value of 100 plus a call option on that stock. So the stock plus put is equal to the PV of the bond with the par value 100 plus the call option. So the first strategy we are going to see is the covered calls, wherein we are writing a call option on the stock that we own. So over here you can see we have made the payoff diagram for covered call. So you have a stock, but you're not sure whether you're going to get more than 10% or 12% or 15%, and you're happy with that. You are going to get 10-15% from the stock. But if the stock is not moving up and the stock is just lying in your account, you might as well sell a call on that stock at a level which you're comfortable. So you sell a call over here on the stock that you own. So this becomes a covered call. The word covered means in case you have to deliver the stock, you already have a stock and hence you're covered. This is not a naked sell call, right? So that was the covered call, and it's denoted by S minus C, wherein you have the stock and you write a call option on the stock. So what could be the maximum profit and maximum loss on this covered call? You have the stock, and at this level you have to deliver the stock. So your maximum profit will be this line. This line can be your maximum profit, because over here if the stock reaches you have to deliver the stock. So your maximum profit will be X minus S, that is the strike price, minus the stock price, that is your maximum profit. But you will also deduct the premium that you have paid to enter into this stock, but in this case you have earned the premium, so you will have a premium as a plus, right? So your maximum profit will be X minus S plus P or C, that is a premium, the premium that you are earning on the call option. And what will be the maximum loss? What happens if the stock goes on the downside? The stock can go to zero, so S can be fully lost. So your maximum loss is S, but you got the premium because you have sold a call. So S minus C, right? That will be your maximum loss, because your stock at if bought at 40 can go to zero and your maximum loss can be 40, right? But you have received a premium, say 5 rupees on the call option. So your maximum loss will be 35, because you have some inflow of the call option. Okay, so this was this, and break even is very simple, S minus C. So we will see how we have come on to the break even. Break even is this part. So here the break even is very simple. The stock that you have bought, that is a cost outflow, and the premium that you have got. So this is our outflow. Say suppose 40 rupees stock, and 5 rupees you have got, or $5 you have got as the premium. So your net outflow is 35. So 35 becomes a break even price. Break even is basically at the cost at which you have fully recovered your outflow. So this was the first strategy. The second strategy is very simple, protective puts. It is buying a put option on the stock that you own. It is basically to protect your downside. With the help of this diagram, we'll explain. So this is a position where you have a stock and you have a put option on the stock. So what could be the maximum profit in this case? Since you have a stock and you have a put option, if the stock is going up, why will you sell it? You will not sell it. So maximum profit is unlimited. Very simple. And what could be the maximum loss? You have bought the stock over here and you have bought the put option over here. So if the stock goes at this level, you will deliver the stock or you will sell the stock. You will sell the stock at this level. So your maximum loss will be S minus P, or the strike at which you have sold the put. This is the maximum loss. But to enter a put strategy, a maximum a protective put strategy, you are buying a put. When you are buying any option, you are paying the premium. So your maximum loss will be S minus P or S minus X in that case. That is the strike price. So your maximum loss will be S minus X, and minus P, because that is the premium that you have paid, right? I'm sorry, plus P. So this is the premium that you have paid. So this will go as a loss. Very simple. We've been doing this all over our CFA curriculum. And collar is basically a combination of covered call and protective put. So you see S minus C is coming from the covered call, and S plus P is coming from the protective put. So over here we saw that here my upside is capped, here my downside is capped. I can have a limited downside. Over here I can have a limited upside. And when I combine both of them, my downside and upside both is capped. If you see this diagram, the payoff is like this. If you see this diagram, the payoff is like this. When you combine both of them, you get the payoff like this. So very simple. Again, the maximum profit will always be between the range, right? The maximum profit will always be between the range. So what is the range over here? Strike price minus stock price and the net premium. Very simple. And what could be the loss? Loss could again be the same thing. Stock minus strike premium. Over here you're taking the call option and here you're taking the put option. So in the profit, you will take the call option. Why will you take the call option in the profit? Because it is coming from covered calls. And in the covered calls, you make profit only when the stock rises above your purchase price and goes up to the call level. And you compute the loss. When you compute the loss, when your stock that you have bought is going down, but when it will reach the put, it will stop making more losses. So stock minus put strike plus the net premium for loss, and for profit we have X minus S, again X at point which you have sold the call option, S plus the net premium. So it's evident from the images also. Profit is capped, loss is capped. So profit on the upper side, what is on the upper side? Call option. What is there on the downside? Put option. So profit, you take the call strike, loss, you take the put strike. We move ahead on the straddles. So whenever in the market the volatility is lower, when the graph looks like this, so the market is mean reverting. It always repeats a history. So traders believe that the volatility will now rise, or if there is any event, if there is a US election or any Fed rate meeting which is going to happen. So the market always anticipates these things and they expect the volatility to go up and the market to show some extreme numbers. So whenever the expectation is for the volatility to go up, you will buy a call option and a put option on the same strike, because you are not sure of which direction the stock will go or the market will go, but you are sure that the volatility will increase. And whenever the volatility increase, what happens? The option prices they increase because that the Vega component starts increasing. So here from the diagram, you can understand that we are buying a call option and a put option on the stock, and the maximum profit is obviously unlimited because you are buying the call option. So your maximum profit is unlimited. The stock, the market can go up to 10%, 15%, or 20%, and at the same time on the downside also, it can go a very large number. So the maximum profit is actually uh, unlimited in that case, because once the call option goes in the money, it starts making huge profit. You will have two break evens because you have two positions, one on the call option, one on the put option. The logic is simple: the strike minus the net premium paid, and strike minus plus the net premium paid. And maximum loss is total premium paid because you are the buyer of the option, and buyer of the option will always have the maximum loss as the total premium paid. I have purchased a call option say for $40 and the put option for $20, so my maximum loss is $60. If the market does not move at all, the maximum that I can lose is 60. So that's the maximum loss. Quite basic from the options perspective. And the opposite of that is short straddle. Like if the market has been very volatile, right? It's shown this kind of volatility all through. Now the traders expect that okay, every bad news and good news has been digested. The market should now become stable. For the market to become stable, the volatility has to go down. And whenever the traders believe that the volatility will go down, they sell expensive options. They sell expensive options. So whenever you sell an expensive option, what happens, you are betting that the volatility will go down and the option will lose value very fast. It is the same concept as buying a put option and buying a call option on the same strike. Here you are selling because you are betting that the volatility will go down. The logic is simple, and the position is exactly opposite. So the maximum loss over here, that is the total premium paid, will be the maximum profit over here because this is a selling position, and the maximum loss can be unlimited. Actually, it can be very dangerous to sell a call option and a put option and expect a short straddle. But the out of the money calls short straddle is not very uncommon. It's very common, and institutional traders make a lot of money out of it. And the position is very simple over here: call option and put option. And the break even is again, it will be the same. If you see, x minus c plus p, x plus c plus, it's basically the strike minus the net premium and strike plus the net premium. Okay, so these were the option strategies. Now we come to the spreads. So what is the bull spread? The bull means that you have to buy low, sell high. Whenever you are bullish, what will you do? You will buy low, sell high. So you can see the positions over here. Buy low, sell high because you are bullish, right? So we see this bull call spread. We buy low and we sell high. Whenever we are bullish on the market, what we'll do? We buy a call option, but we don't know till what level the market can go. But we are sure that okay, at least I believe that my view is at that 5% from here the stock or the market should move ahead. So I don't want to wait for the markets to react to that and all those things and pay a very high option to enter into the strategy. For this, I have paid, say, suppose $40, but now my view is only up to 5%. So I believe that after 5% the market should cool off. So what I'll do is from here, this position, say suppose 100, I'll sell a call option at 105 because there's a 5%. So I'm bullish, but I'm slightly bullish. When I'm slightly bullish, what I'll do is I'll sell a call option and buy a call option. Over here, I had paid $40 to buy this call option, and over here, I'm getting, say, suppose $10 to sell this call option. So my initial cost of 40 has now come to 30 because 40 is my outflow and 10 is my inflow, and that way I've reduced my exposure. So whenever you see the word bull, irrespective of its call or put, always remember you have to buy low and sell high. So that's what the slide says over here: buy low, sell high. What will be the maximum profit in the bull call spread? Over here you have already sold the call, and here you have bought the call. So the maximum profit will be between these two, plus the cost of the position, that is the net premium. That is the maximum profit that you can get, because over here the stock will get called. So this is the maximum profit that you can get out from a strike perspective. But you have also paid some premium. You have paid $30 as the premium to enter into this cost. So that will get deducted from your maximum profit. So your maximum profit will be higher call option, higher strike price minus lower strike price minus the premium. That's what written over here. High strike price minus lower strike price minus the net premium. Again, what can happen as a loss? What will happen as a loss over here? You have bought a call option over here, sold a call option over here. So what could happen as a loss? The stock can go, your call option can go worthless, because if there's a loss, that means the stock is not moving ahead. So what happens to your maximum loss? It is the net premium paid. Very simple. See, here you have bought the call option. If the market is going down, this is worthless. So the premium $40 is gone. Here you have already sold the call option and collected $10. Already $10 is collected, and here $40 is paid. Here we already discussed 30 is the net premium. So wherever the market goes, my maximum loss can be only $30, because here I have collected the 10 bucks, that is the maximum profit I can get as a call seller. And here, if the market goes down, I will not exercise my call option and it will expire worthless. So the maximum loss is the net premium paid. Break even is always the cost that I have paid to enter into this position. So recall that bull means buying low. So we bought low. So this is the purchase, this is the outflow, and what is the outflow is the net premium. So plus net premium. Net premium is 30 bucks. So that's what it's written over here. Lower strike plus net premium. So this was bull call spread. Similarly is the bear put spread. So whenever it is bearish, just forget about the word put or call. Just keep an eye on the bear word and the spread word. Again, we'll take it within the help of the example and the payoff diagram. So what happens in a bear put spread? If you see the payoff diagram is exactly opposite. Now, if I'm bearish on any stock, what will I do? I will first buy the put option on the stock. So when buying the put option, I might pay a premium of say $40 because I'm bearish on the stock. But I might not be that bearish. I will say, okay, I believe that the market can go 5% down. So I will also sell a put. Say, and I collect $10 from there. So from an example, you can say that, say, suppose I want to short Nifty, and I believe, okay, current market is at 17,000. I believe 17,000 put I should buy, but I don't believe that the market will lose more than 500 points. So 16,500 put I will sell. So this I have bought, this I have sell. My position is bearish, right? Because I'm expecting a 500 points downflow. That is why bear. And I've used put options to enter into this. That's why put. And I have two positions, plus and a minus. That's why spread. So it's very simple. Just see what direction you are entering into. It is bearish, put spread. Now what will happen over here is example, if the market goes, let's see the profit scenario. What will be the maximum profit? I have bought a put option of 17,000 and I've sold a put option of 16,500. So if the market reaches 16,500, my positions will get squared off. So what is the maximum profit? XH, higher strike minus lower strike, maximum profit minus the net premium. Because over here 17,000 is the entry point where I am buying the put, and 16,500 is where I have already committed to sell the put option. So this is the maximum profit I can get minus the net premium. That's what we have mentioned over here. Maximum profit is XH minus XL minus the net premium. What could be the maximum loss? That's very interesting. If you just think of it logically, I have a put position plus that I have bought a put option, and I have a put position minus that this is at 16.5, this is a 17k. When will a bearish option give you loss? When the market rises. When the market rises. Now, if the market rises and reaches, uh, if the market rises and reaches 17.5, what will happen to this put option? This will expire worthless. So my $40 premium is gone because if the market is 17.5 and I've bought a put of 17, there's no point in no one is going to exercise that one, right? Because you're in loss and you have already paid $40 for this. But look over here, you have already sold a put option at 16.5 and the market is at 17.5. What is the maximum profit of a seller of an option? It is a premium. So what is your maximum loss? It will again be the net premium because the buying option becomes worthless and the seller option has already earned the maximum profit. So the difference of the premium will always be your maximum loss in any spread, bear or put. bear put or bull call. So that's what we have mentioned over here, the net premium paid. And break even is, again we explain, the option that you are buying. What option you are buying over here? We were buying 17K option and selling 16.5. 17K is the higher strike price, so XH, and there is some cost to enter into this. So we saw that 40 minus 10, so XH minus 30 is your total cost to enter into this strategy. So this was more from a spreads perspective. It's very intuitive once you start making the payoff diagram, or even you start with the first position also. So if someone asks you to make a bull call spread payoff diagram, it's very simple. Bull means bullish, call. If you are getting into a call option, and if you are bullish, you'll obviously buy a lower strike, buy the lower strike and sell the higher strike. This becomes your spread. You don't need anything else because you have sold a call option. Your profit is capped, and at the downside it doesn't matter because you're into a spread. So this way, if you know the one leg of the transaction, you can build all the legs of the transaction. So there are some important things over here to remember. That bull put spread will be exactly opposite to bear put spread. It's very simple and it's very intuitive also. Bear bull is going to be opposite. Put spread is always means that you have two positions. Put is the same component over here. When will you be bullish by using a put? If you are using a put, when will you be bullish? We can make it from here. See both the diagrams. The payoff is exactly the same because over here you are bullish. Here you are bullish. Again the same logic. Bullish. When you are bullish, you will sell the strike. You will sell the strike if you are using the put option. So you will sell the strike put option and buy a put option at the lower strike. Because you are bullish, you want to buy the you want to sell the put option at the higher strike over here, but you also want to protect your downside, and you say that okay, if the market goes down, I need to protect myself, I might as well buy a put option over here. So that's why it's exactly opposite. But if you see from the payoff diagram, it will always be same because, as I said, once you are bullish, the first thing is that you have to do is this: you are into a spread, cap your tails, just cap your tails. Then you have to see whether it's a call or a put. If it's call, just do a minus C and plus C over here because when you're entering into a call position, you will always buy lower. If it's a put position, do a opposite over here. Got it? You sell the lower call strike and buy the higher strike. So this way we can do the spreads. Just know the first leg and the other legs will follow. So option Greeks is we have covered a lot of time. So let us just touch base briefly. So we know that delta is of the change in the option price for 1 point change in the stock price. Long calls and short put. We saw over here that long call and short put will have the same payoff. So long call and short put has positive delta. Short call and long put has negative delta, and all delta always takes a value between 0 and 1. Gamma is the change in delta for 1 point change in the option price. It is always higher for the ATM options and highest when expiry is nearby. Gamma is always positive. So all these three statements are very intuitive in that sense. You just make a logical this thing that suppose your strike is of $40 and currently the stock market price when you had bought it was 35, and say it had a delta of say 0.25. Now the stock price has reached 40. Delta will be close to 1. Why delta will be close to 1? Because uh, it is between 0 and 1. and it is change in option price for one change in stock price. It will not be 99 exact, maybe 95 or 94. That doesn't matter. The concept is basically if the stock price goes at the money. Now the stock price is at the money. 40 is the strike. Stock price is 40. Now with respect to 40, this cannot change anymore, right? It's almost reached 40. When the change is not possible and any more change is not possible in the delta itself, what will happen to the gamma? Gamma will always be highest because there cannot be any more change in the delta. So we know that option value is IV plus TV, which is intrinsic value plus the time value. So over here, intrinsic value at 40 becomes highest, and time value will take lower weightage over here. But over here, if you see the intrinsic value is more, and say suppose let's say for simplicity in example the stock reaches 44. Now the intrinsic value is more, the stock becomes in the money, and once it becomes ATM or in the money, there are very few scope for the delta to move beyond 1, and delta, the maximum value that the delta can take is 1. When the delta cannot change, the gamma cannot change because it is a change in delta, hence gamma is the highest. Gamma is always positive, yes, because it's the change in the delta, and delta is the change is always is measured in positive things, in positive value. Okay, and theta we all know is the enemy of the buyer of the call option. So it's negative for long option and positive for short option, highest for ATM options for the same reasons. So when we know that this is the out of the money, this is the ATM at the money call option theta dk, and this is the in the money call option theta dk. So remember from your basic L1 L2 classes that at the money options will lose value as and when they reach expiry, and the speed of losing value will be very high because right now there are very few chances that the stock can go beyond the strike price because the expiry is very near. But in the money option has a lot of intrinsic value, and if the stock has a lot of intrinsic value, it will have lower time value. In the previous slide, we discussed that option is IV plus TV, and for the ITM options, IV is higher, so the TV will be lower because the combination of those is the option prices. It is negative for long position, positive for short position. That's how we trade in the market. Vega is basically the change in option price for 1% change in stock volatility. Again, it is highest for ATM options and loses value as theta increases. That is lesser time to expiry. What will happen on 2 3 days before the expiry? The stock, suppose you had bought at 40, the strike at 40, and the stock is trading at 32, and there is only 2 days to expiry. The chances of 32 reaching 40 in 2 days is very less. Now, because it is very less, the Vega loses value. Why is it less? Because theta is the maximum over here. You have only 2 days from expiry, so theta becomes maximum, and whenever the theta becomes maximum, the Vega will lose its value because the volatility, the market presumes in 2 days that it cannot reach 4 5% from here. So that's what this statement means. A very simple thing that we have been doing all our CFA curriculum is the spreads, the calendar spreads. Over here we are basically exploiting the theta, which is the time value. Keep this equation in your mind and you'll be able to solve any option problem. IV plus TV, any option Greek issues also. Intrinsic value plus time value. So long calendar spread is when I am having a bullish view. So suppose sitting in September, I believe in January the Nifty can reach 20,000. So I bought a 20,000 call option. But it will cost me some money. Yeah, it will cost me say 40 rupees example. But I believe that in the near term the market is going to go down, and my belief is by the time it reaches Jan, it will come up. So what I'll do is I will sell the call option of 20,000 in near term, and I might collect say suppose $5 from that. because it's shorting the near date option, so the value will be low. So what I've done, I've effectively reduced my cost of the call option. Call option costed me 40 rupees. Now because I've sold the stock, I have sold the call option, I've reduced my cost. My view is bullish, but I'm not bullish immediately, so I might as well sell those call options. But I'm bullish in the month of Jan, so I will buy the call option. Since there are two different months, it's known as a calendar spread. Had it been in the same month, it could have been your normal spread that we have seen, bull and bear call spreads. Short calendar spread is exactly opposite. When I have a bearish view that okay, the market is going to go down, but immediately it might not go down. Immediately it might be like this, but in the January month it might crash. So I will do the opposite. I will buy the near dated options because right now I believe that the market is not going to fall, and sell the distant options because I believe that in Jan the option will lose values and I will earn the premium and keep the premium with me. So that is a bearish view. Volatility skew, implied volatility increases for OTM puts and decreases for OTM calls. It is a bearish indicator. So in the market, you have both the things. You have puts, which is on the and the call. So buyer of the put option is basically bearish, right? And suppose the market is trading at 17k right now, and suppose 16.2k is the strike at which the maximum puts are bought, and 18k is the out of the money strike where the OTM strikes are. Now, if in the option chain I see a lot of contract being bought at this level, which is highly out of the money, 800 points from current spot price, and at the same time I see long unwinding over here, I see call option writers and call option buyer running from here. What will happen whenever I'll plot this thing? It will become like this. If I plot the open interest, because at this strike the open interest is highest, so it's skewed towards the puts. Whenever the traders find these kind of patterns, they believe that it's a leading indicator for a bearish market and the market might fall. Volatility smile further from the ATM options have increased implied volatilities. It's from the same things. It's from the same this thing that currently suppose the market is at 17k and 18k call option and 16k put option. Those are finding the lot of interest, but as and when you are getting closer to this thing, there are very few buyers. But as and when you're going slightly out of the money, the interest is buying. So what does this volatility smile means? Volatility smile means that the market is expecting a huge volatility on either side. But which side? That's not sure. So that's why there is a smile. And whenever you expect volatility to increase, which strategy you will increase? You will get into a long straddle. So you see all the slides and all the chapters are interrelated. The basic concept is to understand the spreads and the positions, and I think so will be good enough. Thank you.